Hello and welcome to our discussion on accounting. In this session we will try to understand the process of converting business decisions into financial statements. For this purpose we'll take a set of business transactions and we'll convert that into balance sheet, income statement and cash flow statement. So on 1st April 2013, A started business with 50,000 rupees as capital. So that means the business has received capital of 50,000, and this receipt of cash is not an income but a source. So a receipt resulted in creation of a source and availed 10% loan from SBI on the same date, and so once again the company received 200,000 and that is it's a receipt, not an income but a source. So we can see that every receipt is not an income. Till now both these receipts are the sources, one as a capital and other is a loan. Then we use this cash to purchase 100 old paintings for 150,000 for a local painter. So you can see that in this case we paid money, there is a cash outflow, and so there is a payment of 150,000 and this payment is for painting on this date, so therefore I created an asset. The payment has resulted in the creation of assets and the asset is the painting. It is an asset because it has the potential to create cash flows in the future. So payment has resulted in asset and a receipt has resulted in capital and loan. Participated in exhibition and sold 60 paintings for 450,000. Participated in an exhibition and sold 60 paintings for 450,000 for cash. So this is an income. So I am making a sales of 450,000. And though it is no information is given, let us assume that this is for cash. So entire sales is for cash. So there is a receipt here which is an income. But previous to these, previous receipts are not incomes but capital and the liability. So every receipt is not an income is very clearly visible in these three items. And as per the matching concept, whenever there is a sale, there has to be cost of goods sold. There has to be cost of goods sold. The cost of goods sold in this case, the 60 paintings, and the cost of each painting is 1,500. So 60 into 1,500 is the cost of goods sold, and to that extent the paintings will reduce. To that extent paintings will reduce. You can see that 150 minus 90 is equal to 150 minus 90 is equal to 60,000. Once again we sold 20 more paintings to a local school, 20 more paintings to a local school at the rate of 3,500. So there is a sales of 3,500 into 20, but here we have not sold that on for cash, so there is no cash flow, but there will be a creation of an asset, and the school is a asset here because you are going to collect money from the school. So it is also called a debtor or receivable. You can also ask a question, if it is a credit sales, why are we recording it? The recording of transaction is governed by an accounting concept called accrual principle. So the accrual principle says that the transaction should be recorded at the time of happening of the transaction, irrespective of the actual cash inflows and cash outflows. So we have recorded the sales because of the accrual principle, and there is no cash flow to that extent. But whenever there is a sale, there has to be cost of goods sold, and the cost of goods sold is 60,000, is how many? We are selling 20,000, so cost of goods sold is 2,000 at the rate of 1,500, so it is 30,000. We can see that the 20 into 15, as a result the number of paintings has come down from 150, so 90 minus 30, so it is 60,000. Paid 50,000 is a participation fee, so there is an expense and we paid money for that. An expense will be shown in the income statement. We also paid, so paid for the exhibition fees. We also paid interest on 31st March. So on the loan, interest is an obligation, so therefore interest has to be paid, and the amount of interest is calculated on the loan, and the interest is 10% of, interest is 10% of the loan, okay, 0.10 for the year, because we have taken the accounting year as 1 year. And also there are other expenses we paid during this period, and the other expenses is equal to 10,000. So there is an outflow of cash, other expenses 10,000, and other expenses will be shown on the income statement as an expense. So all the transactions have been entered. Now once all transactions have been entered, we'll first find the profit. Profit is equal to incomes minus expenses, and expenses is equal to the summation of all these items, that is 200. So therefore profit is equal to income minus expenses 320. So there is a decision to be taken here now. When a company makes profit, the profit can be distributed as dividend or can be retained, and if it is retained, it becomes a source. If it is retained, it becomes a source. The entire profit is retained in the business. Now let us find the cash in hand. Cash in hand is equal to cash available minus cash payments. So cash in hand is equal to 700,000 minus 230, so 470, and cash is an asset. So cash is an asset. So since profit is transferred from the income statement and cash is transferred from the cash flow statement, this also shows the interrelationship between balance sheet, income statement and cash flow statement. And also interesting and important to observe, cash in hand is not equal to profit, because every receipt is not an income and every payment is not an expense. So now since all transactions are done, the summation of expense, the summation of the sources side, should be equal to the summation of the asset side. The summation of the asset side, that is 570. So we can see that a set of business transactions can be converted into financial statement using the principles of generally accepted accounting principles, and in this case we have used the matching principle, matching concept, we have used the accrual concept, and we have used the accounting period concept. We also use the business entity concept to drive in that these are the financial statements of the business, not of the business owner. Thank you very much.